and welcome to our latest fund manager interview. With me today is Duncan MacInnes, who is the co-manager of the Ruffer investment company. Duncan, thank you for your time today.
Thanks for having me, Cal.
The portfolio has around 40% exposure to equities, and in terms of countries, the UK is the highest weighting. Has that been a long-standing position, or have you been increasing exposure lately, particularly following the Brexit deal?
Yeah, so that's a good question. The first thing to say is we're global investors, so there's no home bias in the portfolio. Back when I joined Ruffer in 2012, we had 50% of the equity book in Japan, and we still have a large weighting there. So we do look globally. The reason that we had a big weighting or have a big weighting to the UK is that we thought in the run up to the December 2019 general election that the UK looked really interesting, and we had a strong conviction that Boris Johnson would lead the Conservatives to a big majority and move forward with Brexit and reduce the uncertainty that had hung over the UK for at least 6 years with the political turmoil around Scottish independence referendum, Brexit, the threat of Corbyn and so on. And as a result of all that uncertainty, international investors had fled the UK and were hugely underweight. In fact, you have to go back to the 1970s to find a period where the UK had underperformed so much, and that was the winter of discontent. So really not a good period in the UK's history. And Apple alone was now worth more than the entire FTSE 100. So that was the sort of reason why we increased the weighting back in late 2019. Then, of course, Harold Macmillan's event steer boy got in the way. COVID-19 struck, and botched handling of that has not helped. So today we've got a bit less confidence in the idea of significant government-led reform than we did. But the truth remains that the UK is still a deeply unloved, lowly valued market. And what's really interesting is that the corporate world is agreeing with us. So we've seen 2 years in a row of record M&A transactions with foreign buyers coming in and snapping up UK assets, which look very cheap on a sort of global comparative basis. And in the UK, it's not all doom and gloom. The vaccine rollout seems to be going very well. We could be at the front end of countries to reopen, and there's a great deal of support for the economy in zero interest rates and monetary and fiscal stimulus. Also, I think the Bank of England and Downing Street appear to be a lot more joined up than most of their global counterparts, apart from maybe Japan. So the prospects for the UK look quite good with that combination of low starting valuations, an improving vaccine situation, and monetary and fiscal policy being aligned.
And in the top 10 holdings, there's a couple of UK banks. There's NatWest Group, Lloyds Banking Group, and Barclays. Presumably, this is the sector that you're finding attractive at the moment.
Yes, it is. But also, I think one thing that investors find quite confusing about Ruffer is that we ask people not to consider the holdings in isolation, because often the role that individual holdings play as part of the overall portfolio is just as important. So we do have 5% of the portfolio in UK banks today, and that's because there's bottom-up reasons and top-down reasons. The bottom-up reasons are that we find them attractive because they're arguably the most hated sector in the most hated market. But upon deeper analysis, they're nothing like the banks of the financial crisis. Semi-seriously, I ask people to think about the CEOs of big banks now are like compliance officers and risk officers rather than the swashbuckling investment bankers of previous days. That's the mentality shift that's gone on at the top of these businesses, and there's a newfound conservatism in there. They've de-risked hugely. The balance sheets are robust. They have NatWest and RBS in particular have enormous excess capital reserves, and they're all highly profitable today, even in the most inhospitable of environments. So imagine what that could be like if the economy improved and things got better and interest rates ticked up. They also work as a reopening and recovery play. They're geared into an improvement in economic growth. just like other stocks in the portfolio, such as American Express or MacInnes, which owns Spanish airports. Top down, why do we have a big weighting in the UK banks? We like them because they act as a hedge to the index-linked bonds in the portfolio. Now, Jonathan Ruffer is on record that index-linked bonds are the crown jewels of our portfolio, but they are vulnerable to an uptick in interest rates, which is exactly the thing that would most benefit the UK banks. So it's really useful to have that in the portfolio, and that's the essence of what we're trying to do more broadly at Ruffer, which is to find individually attractive investments which can act as a hedge to each other and reduce some of the specific risk.
And compared to a year ago, prior to the sell-off taking place in the first quarter of last year, has there been many changes made to the equity part of the portfolio? Did you use the market falls as an opportunity to pick up some bargains?
Yeah, when the market was down 30% in March 2020, our portfolio was flat, which was nice, because what that allows you to do is to be on the front foot and look for those opportunities rather than hiding under the desk, wishing that it would all stop, as I'm sure some others were. What did we do? We made big investments into gold mining equities and to US Treasury inflation-linked securities at the bottom, which was good. What we didn't do much of was buy equities. In hindsight, I think that was a mistake. But on a risk-adjusted basis, we felt that those other assets, the gold and the tips, were more attractive. They were equally distressed, actually, at the time. And they were closer to the point where we feel governments would intervene to benefit from that. So what else has happened in the equity book? We still have a preference for value and cyclical stocks because they offer that exposure to recovery and reopening. But we have been able to, over the course of 2020, upgrade, I think, the caliber of the businesses that we own a little bit. So selling things like steel manufacturers and cement manufacturers and replacing them with Charles Schwab, American Express, Vinci, which owns airports and toll roads, or even Walt Disney, which remains encumbered by theme parks and cinemas being closed. We've also we've built a separate sort of US healthcare basket, which is quite interesting.
Duncan, thank you very much for your time today.
Thank you.